All right, let's dive into a real mystery that's been stumping investors for years. It's often called the Korea discount, and it's this fascinating puzzle about why some of the world's most successful companies seem to be perpetually on sale. We're going to break it down.
So here's the core of the puzzle. You've got these huge, globally recognized Korean companies. I mean, household names, right? But when you look at their stock price, the market is basically saying the whole company is worth less than the value of its physical stuff. Its factories, its cash in the bank, all its equipment. How is that even possible?
And we're not just talking about a few companies here. Get this, more than half, over 50% of all companies listed on the Korean stock market are trading for less than what their accountants say they're worth on paper. That is a staggering number, and it's not something you see in other major markets around the world. So, what is going on?
Okay, to really get our heads around this, we need to know one key metric, the PBR, or the price-to-book ratio. It's actually a pretty simple idea. You just take the company's total stock market value, that's the price, and you divide it by the net value of all its assets on the balance sheet, that's the book value. If that number comes out to be less than 1, it means the stock is trading for less than it's technically worth.
And that's what's so weird here. I mean, think about it. A company is a living, breathing thing. It's not just a pile of assets. It has a brand. It has brilliant people. It has incredible potential from all its research and development. None of that stuff is really captured on the balance sheet. So in a normal, healthy situation, its market price should be way higher than its book value, giving it a PBR well above 1.
So the Korean government is looking at this situation and, they see it's a problem. So they've come up with what they're calling the official solution. It's a plan called the Value Up Program. The name kind of says it all, right? The goal is to get these company valuations heading in the right direction. But how are they planning to do that? Well, the logic seems pretty straightforward on the surface. The program basically nudges companies to give more of their cash back to their investors. The main ways to do this are by paying out higher dividends or by buying back their own shares from the market. The idea is that this makes the stock more attractive, people will want to buy it, the price goes up, and boom, the PBR climbs back above 1. Seems simple enough.
But, and this is a big but, does that really fix the root cause of the problem? Is the low stock price the actual disease, or is it just a symptom of something much, much deeper? Forcing companies to just hand out cash might feel like an easy win, but what if it totally ignores the real reason the market is so skeptical in the first place?
To really get to the bottom of this, we need to look under the hood at the real financial story playing out inside every single company. You can think of it like a constant battle. A tug of war between two really powerful forces. What a company actually earns for its owners and what those owners, the investors, demand in return for risking their money. On one side of the rope, you have ROE, which stands for Return on Equity. The easiest way to think about this is like the company's report card. It tells you how much profit it's making with the money that shareholders have invested. And on the other side, you've got COE, the cost of equity. This is the investor side of the bargain. It's the minimum return an investor says they need to make it worth their while to take on the risk of owning that stock. And here's where it all clicks. This table basically shows you how the market delivers its verdict based on that tug of war. If a company's report card, its ROE, is better than what investors are demanding, the COE, well then it's creating value, and the market rewards it with a PBR greater than 1. But if that company's return is less than what investors demand, it's actually destroying value, and the market's judgment is swift, a PBR below 1.
So this completely reframes the whole issue, doesn't it? A low PBR isn't some magic 50% off sticker. It is a clear, rational signal from the market. It's the market basically yelling, hey, this company is not earning enough to justify the risk I'm taking. The problem isn't really the price tag. It's the performance.
And that brings us right back to the Value Up program. If the real issue is a low ROE, a poor report card, does forcing a company to just hand out cash actually fix anything? In fact, it could make things a whole lot worse in the long run. See, a healthy company has this natural cycle for its cash. Think of it like a circulatory system. First, it makes money from its business. Then, and this is the critical part, it reinvests a chunk of that cash back into itself to create future growth. Building new factories, funding R&D. That leads to even higher profits down the road. It's only after all that, the excess cash that's left over, that's what should be returned to shareholders. And this is the real danger.
Forcing a company to pay out cash before it's had a chance to reinvest is basically asking it to sacrifice its own future. The analogy here is perfect. It's like a farmer eating the seeds for next year's crop. Sure, it feels good to have that meal today, but you're going to be starving tomorrow.
That reinvestment is the absolute engine of real long-term value. It's what pays for the research that creates the next breakthrough product. It's what builds the new factories to meet more demand. It is the only thing that can truly drive that ROE higher over time. That's why, as an investor, if you see a company paying out huge dividends but not investing in itself, that should be a massive red flag. It's basically telling you it has no good ideas for what to do with its money.
So, after all this, what's the real takeaway? How should you, as a smart observer, actually look at these cheap stocks? It means you have to look beyond that simple PBR number on a screen.
The true path to finding value is all about the fundamentals. First, look for companies that already have a high return on equity, a great report card. Then do your homework. Are they investing that money wisely to keep growing? Because at the end of the day, a high COE, that high demand from investors, can also be a sign that they just don't trust management to do a good job. The goal isn't just to magically get a higher PBR, it's to find a fundamentally stronger, well-run company. That's what creates real, lasting value.
And that brings us to the final question to leave you with. The next time you see a stock with a PBR way below 1, you'll know exactly what to ask. Is this a real bargain? A hidden gem the market has missed? Or is it just a warning sign? A company that's failing to create value masquerading as a good deal? Now you've got the tools to figure it out.